Hello and welcome to youshallpass.com.
This video is a part of reading 57 and it introduces the concepts of zero volatility and option adjusted spreads. It highlights some of the shortcomings of conventional yield measures such as nominal spreads, and then lays out how these shortcomings are addressed using Z-spread and the option adjusted spreads. It also provides a contextual framework within which to understand some of the newer concepts that are introduced, and this video builds heavily from the material we introduced from an earlier video regarding spot and forward rates. So you might want to recap the material from that video before proceeding with this one. Nominal spreads are the easiest to understand and thus also the most conventionally used measure of yield spread of one bond over another. It's simply the difference in YTM between two bonds of comparable maturity. For example, if you take the US Treasury yield curve from Jan 2003, the yield on a 5-year Treasury note was 3.05%. And if at that point in time a BBB rated corporate bond, which also had 5 years remaining to maturity, if that yielded 4.5%, then the nominal spread between the two would be 145 basis points. This is the risk pyramid that we've been using across a lot of our videos regarding interest rates. It basically decomposes interest rates into the various risks that they are compensating an investor for. Depending on which two bonds we're comparing, the nominal spread can be considered as compensation in yield for the difference in risks between the two bonds. Going back to our example about the 5-year T-note and the 5-year corporate bond, we can examine the risks that are inherent in both bonds. The US Treasury notes are issued by the US government and usually have a fairly active liquid market, so they don't carry credit or liquidity risk. They don't carry embedded options, so that one's out as well. But the risks an investor does run while investing in US Treasury notes are inflation and maturity risks. The 5-year corporate bond, of course, carries a BBB rating, so in addition to the risks inherent in a UST note, a corporate bond also exposes an investor to credit, liquidity, and option risks. In exchange for these extra risks, the corporate bond carries 145 basis of extra yield. So what we come back to when we started the slide is that additional yield, as measured by the nominal spread, is a measure of the compensation received for additional risks undertaken. The first shortcoming of the nominal yield metric is that it's a measure of spread at just one point on the yield curve, and as such it doesn't take into account the term structure of yields for either of the bonds being compared. The second shortcoming of the nominal spread measure is specific for bonds with put or call options. And that simply is that due to its simplistic nature, the nominal spread measure fails to take into account the change in YTM brought about by exercise of these options. And that in turn is obviously triggered primarily by changes in the interest rate or the overall business environment. The zero volatility spread, or as it's more commonly known, the Z-spread, aims to remove the first shortcoming of nominal spread. It measures the difference in yield not as the difference in YTM at any one point in time, but as the average spread along the entire spot rate curve. Therefore, if the corporate bond is held till maturity, the Z-spread measures the average number of basis points of extra yield that the investor will earn over each point of the current spot rate curve. Admittedly, this isn't the best definition I've ever read or read out, but the fault isn't entirely mine. Quite a bit of it lies with the concept too. But as we've done so many times along these videos, things will get clearer once we lift the hood and look under it. And once we stop speaking and start looking at the numbers, hopefully the picture will get clearer. Definitionally, what the Z-spread is the number of basis points that need to be tacked on to the spot rate curve so that when the bond is discounted using this discount rate, the present value is equal to the current price of the bond. It's calculated by tacking on an X number of basis points to each point of the spot rate curve and using the resulting interest rate to discount the cash flows of the bond under consideration. We keep doing this until the number of basis points that equate the present value to the price of the bond is arrived at. And that number of basis points is your Z-spread. In cases where the spot rate curve steepens sharply, or where the bond for which the Z-spread is being calculated is an amortizing bond rather than a bullet bond, in these cases the Z-spread is especially a better measure of incremental yield versus incremental return compared to the nominal spread. Otherwise, usually there's not a lot of difference between the Z-spread and the nominal spread. We show here how the Z-spread is arrived at. Let's take the bond we had started the example with, a BBB rated corporate bond paying 4.5% a year coupon and trading at par with 5 years to maturity. We're using the same spot rate curve derived from the 2003 US Treasury yield curve, and if you remember, we derived this the spot rate curve in the video about spot and forward rates. We've said throughout this series of videos on fixed income that the bond world lives, breathes, and calculates in 6 monthly intervals. So we lay out the time horizon of 5 years divided up into 10 half years. We then take our spot rate curve, and to begin with we tack on nominal spread on top of it along all points of the spot curve. This then gives us our discount rate. We then half this bond equivalent discount rate and calculate discounting factors for each half year over which discounting will take place. This last step, of course, happening in the last column on the right. And here we multiply the cash flows with the discounting factors. Needless to say, you should pause this video here and rework the calculations for a few time periods yourself before moving on with the rest of this video. The total of the discounted cash flows works out to slightly in excess of $100 or par value, and since the bond is trading at par, we need a higher discount rate to lower the present value. So the true Z-spread is then slightly in excess of the nominal spread of 145 basis points that we'd use to kick this exercise off. In Goldilocks terms, this porridge is too hot. Here we have the same example with a higher assumed Z-spread. Previously it was 145 basis, but here we've cranked it up to 150. The effect of this cranking up is that the present value has come down from above par to below par now. And since the prevailing price of the bond is par, the true Z-spread then lies somewhere between the nominal spread of 145 and 150 basis points. As Goldilocks would say, this porridge is clearly too cold. The Z-spread that we've shown here and that we've quite obviously arrived at using the goal-seek function in Excel makes the porridge just right. The discounted cash flow sums up exactly to 100 using a Z-spread of approximately 148 basis. While the actual calculation of the Z-spread may seem facile now, the theory behind it and what it represents are quite solid elements of bond theory and should be understood well, not only for success in practical life, but also because this can be tested in the exam. This calculation that we just performed then is identical in its objective to the YTM of the bond. In fact, we just did calculate the YTM of the bond, not as an absolute number, but as an absolute number that's added to another set of various absolute numbers. In essence, then, the Z-spread is another way of expressing the YTM, but expressed like this as a spread, it measures not yield but rather the extra yield that an investor is earning in exchange for assuming extra risks. It's important to understand here what these extra risks are. The Z-spread measures the extra yield in exchange for all those risks that are not contained in the spot curve. And as typically is the case, if the spot curve is composed of treasury spot rates, then the Z-spread is measuring the cumulative compensation over and above the treasury spot rate curve for all the additional risks the bond investor is taking on by investing in the corporate bond rather than a treasury bond of equal maturity. In theory, there is nothing stopping the analyst from using any set of spot curves or spot rates that she likes, as long as the underlying rates represent reliable prices in a reasonably liquid market. Then any set of spot curves can be derived and deployed with some pretty interesting results. For instance, if the analyst started using the BBB rated corporate bond spot curve rather than the T spot curve, then the Z-spread would represent the additional return being earned as compensation for the issuer-specific risks or the issue-specific risks. For example, liquidity may differ considerably between various bonds in the BBB category. Difference in the embedded options is obviously another source of additional risk, or this particular issuer may have had some recent developments specific to itself which can affect bond prices compared to other BBB rated issuers in the same sector. So you can see that in this way, with the appropriate set of spot curves and the Z-spread technique, the analyst can parse all the additional risk and work out the yield being offered in exchange for each. For example, if liquidity for a particular bond is an issue, a reliable spot curve composed of some low liquidity bond index of comparable credit quality that can be used to parse out the return related to the liquidity risk. In fact, we are going to do some parsing next in relation to the spread or the additional yield a bond offers in exchange for its embedded options. Quite rightly, the measure that is derived from this parsing, this measure is called the options adjusted spread, and it's coming right up. For bonds which carry put or call options, the cash flows of the bond can change quite dramatically if either option is exercised. Cash flows that look like this can suddenly turn into this. Naturally then, the present value of the cash flows or the fair value of the bonds that needs to factor in this potential alteration in the cash flows of the bond. The conversion of the difference in price and fair value of the bond into a spread over a benchmarked spot curve is done via the option adjusted spread. Specifically, definitionally, the option adjusted spread is the number of basis points to be tacked on to each point of the benchmark spot curve so that the fair value of the bond equals the currently prevailing price of the bond. For a bit of background, let's talk about how the cash flows change when put and call options are exercised, thereby implying a short, to-the-point discussion about what put and call options are. Let's start with put options. These give investors the right to sell the bond back to the issuer at a predetermined price, regardless of the prevailing market price. It's not an obligation, but the right. So, for instance, if the bond can be sold back to the issuer at par or 100 cents to the dollar, the investor will hang on to the bond as long as the market price of the bond does not fall below 100. If, however, interest rates rise or the credit rating of the issuer declines, the price of the bond will decline. And as soon as it goes below 100 and looks like it's going to stay below 100, the investor will exercise a put option and put or sell the bond back to the issuer. The price of par or whatever price is determined at the outset to put the bond back to the issuer is known as the strike or the exercise price of the option. Call options, on the other hand, provide issuers with the right, not the obligation, but the right to buy the bond back from investors at a predetermined price, regardless of the prevailing market price. So, as long as the prevailing market price is lower than the exercise price, the call option will remain unexercised. But if interest rates decline or the credit rating of the issuer improves, it becomes cheaper for the issuer to borrow funds. Inevitably, the improvement in the business conditions will start to reflect in improved prices for the company's bonds, and in that case, it makes financial sense for the issuer to call or to buy back the bond and maybe then reissue another bond at a cheaper interest rate. If, on the flip side, the interest rates rise or the creditworthiness of the issuer worsens, this will start to reflect in the price of the bonds. And if the price of the bond goes below 100 and looks like it's going to stay there, the investor can exercise her put option and put or sell the bond back to the issuer. And as we had mentioned earlier, if either the put or the call gets exercised, cash flows that look like this can suddenly turn into this. Cash flows change, the present value of those cash flows changes, and that obviously changes the fair value of the bond. And the option adjusted spread then is the number of basis points to be tacked on to each point of the benchmark spot curve so that the fair value of the bond equals the currently prevailing price of the bond. Alright, we move on now to how the option adjusted spread is actually calculated. And how it's actually calculated is via interest rate modeling. We use software running an interest rate simulation model to generate our interest rate tree. These interest rates then represent the spot rates along a single yield curve that will be used to discount each cash flow of the bond. At each branch of the tree, we add on a number of basis points so that the discounted present value of the bond's cash flows equals the current price of the bond. These extra number of basis points are represented by these orange stripes or orange strips along the blue interest rate boxes. And if at some point along the tree the projected interest rate reaches such a value that a put or a call option will be exercised, well, that's dealt with as well. You assume that the investor will get paid the put or the call price of the bond at that point, and there will be no more cash flows beyond that point, and that will be that. Thousands of such interest rate scenarios and resultant spot curves are generated via simulation, and as we had mentioned before, these simulations naturally also cover interest rate zones where the put or the call options are likely to be exercised. For each new interest rate scenario, each new spot curve, the fair value of the bond is calculated, and then a certain number of basis points are added on to each point along the spot curve so that the current price is discounted such that it's equal to the fair value. Thousands of scenarios. Thousands. Yeah, still going on. Thousands. This could go on for a while, but I'm sure you get the idea. And the idea is that there are thousands of scenarios. So once all that is done, what we then have are thousands of instances of a certain number of basis points of spread that have been added to our thousands of simulated spot curves, including cases where the interest rates have ventured into option exercise territory. We then average out these basis points of spread over all these thousands of scenarios, and that average of the basis points of spread over all these scenarios, that average is known as the option adjusted spread. That is the spread that's required at present to be added to all points of the future likely spot curves, so that the present value of the cash flows of the bond, which are discounted as per the future likely spot curves, that present value equals the currently prevailing price of the bond. As such, then, the option adjusted spread calculation is heavily model dependent. It depends on the interest rate projection model that is being used, the interest rate volatility assumption being used, and of course on the underlying spot curve that's being simulated. Due to these reasons, two people can come up with two different values for a particular bond's option adjusted spread, and both of them can be right. We've defined and derived the zero volatility spread, and we've defined and derived the option adjusted spread. It's now time to develop the relationship between the two. The Z-spread, as we know, is the spread that the bond enjoys over the benchmark spot curve, assuming that interest rates don't change from here on and are not volatile. That's probably why it's known as the zero volatility spread. The option adjusted spread, as we just discussed, does account for changes in the interest rates going forward and accounts for changes in the cash flows due to the put or call options being exercised due to changes in interest rates. These two measures of spread are linked by the following formula, whereby we've introduced a third component in the relationship, namely the option cost. As per the formula, the option cost would be derived as the difference between the Z spread and the option adjusted spread. What the option cost is the difference between the spread over the benchmark spot curve that would be earned in a static interest rate environment, and the spread after adjusting for the possibility of the bond's put or call option being exercised. The last bit I've carried verbatim from the curriculum readings because for some reason I found it expressed so clearly and simply there. I doubt anyone could or should even try to do better. Needless to say then, that for bonds which do not have embedded put or call options, the option cost is zero. And in these cases, the Z spread will equal the option adjusted spread. However, for cases where the bond does have embedded put or call options, the option cost can be positive or negative depending on who holds the option. Generally speaking, the party holding the option is the party paying the option cost, and the option cost will be positive or negative from the perspective of the investor. For example, for a call option, the issuer holds the option to call the bond back. Hence, the issuer pays option cost to the investor, and the option cost is termed positive. For a put option, the investor holds the option to put or to sell the bond back to the issuer. Hence, the investor pays the option cost to the issuer, and the option cost is negative. By now, we've talked in depth about all three spreads, that is the nominal spread, the zero volatility spread, and the option adjusted spread. This table shows what each of these spreads are benchmarked against and what they actually measure, and as in what risks do they measure compensation for. Nominal spread is simply the difference in YTNs of a bond and that of some other comparable bond. The nominal spread ignores the term structure of the interest rates as quoted for a particular maturity. It can and often does vary over the length of the yield curve. The Z spread and the option adjusted spread are both usually benchmarked against treasury spot curves, in which case they represent compensation for issuer and issue specific risks. When benchmarked against the issuer's own spot curve derived from the issuer's own on-the-run bonds, these measures reflect compensation only for the issue specific risks. The option adjusted spread which seeks to isolate the option cost out of the Z-spread, normally represents compensation for credit and liquidity risks. However, if it is benchmarked against the issuer's own spot curve, then the credit risk bit is obviously absorbed into the spot curve, so the option adjusted spread only reflects compensation for the issue's liquidity risk. That's it then. That's about all you need to know about nominal, Z, and the option adjusted spread for the CFA Level 1 exam, and actually pretty much all you'll ever need to know about these topics. The practice questions at the end of the reading provide a very good idea of the frequency and the type of questions that are usually posed in the exam, and you should now be able to comfortably attempt all questions regarding these types of spread. Practice hard, practice plenty, have faith, and hopefully you shall pass.